I promise these dividend growth recaps are not designed to gush even more about SCHD. But hey, my favorite dividend growth ETF ran laps around the competition once again in the fourth quarter of 2024. We're here to compare the key metrics of SCHD, DGRO, VIG, and VYM on a quarterly basis. I consider these to be the staples of the dividend ETF world. I am open to adding new ETFs to the mix, but they must have at least 10 years of data and they need to be legit. SCHD did not run away with all the categories in 2024. In fact, outside the dividend stats, it struggled compared to these other behemoths. We'll get into everything you need to know about these top dividend ETFs in this video. If you're new to the channel, welcome. My name is Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please iron fist that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to mind. We had one new channel member this week. A huge thank you to Travis for joining the membership, and to all of you that have been here all along. This is my 100th video, and it's being recorded on Christmas Day. I feel like it's kind of a special one here. Huge shout out to all you members. Thank you for making this possible, and Happy New Year's by the time you're listening to this one. You know what time it is. Let's grow. Dividend yield versus dividend growth. I have stressed the importance of dividend growth over dividend yield in most of my other videos. And dividend growth is more important over the long haul because of how the compound math works. But I wanted to give a little love to dividend yield as well. Yield on cost is the cash flow metric that matters long term. And you won't get to where you need to be in most cases without a solid starting yield. Let me show you what I'm going on about here. I threw together a spreadsheet with 4 made-up ETF examples. So the person in this scenario had $1 million built up over their working career between 401ks and Roths and traditional and taxable accounts. So I just want to show the difference of a high starting yield and low growth to high growth. So you can see here, and we wish we could have this, let's be honest. We wish we could have any of these. Now we have this. This is SCHD. Its 10-year dividend CAGR is just over 11%, and its yield's actually in the mid threes. This one's only 3 flat in this example. So I'm always stressing the importance of dividend growth, and we're cheating here. Would you rather have $195,000 a year or $1.75 million a year? Growth, growth, growth. But we got to step back and realize on year one when we retire, especially if we don't have Social Security or a pension, $90,000 certainly sounds a lot better to me than $30,000 to get by and pay the bills. So you might be able to do this right off the bat if you have a bunch of other cash, money markets, or investments. But if $1 million is everything, you probably can't go for something with so much growth when you need more than $30,000 to pay the bills. So I want to give a little love to this high yield. This is basically my JEPQ. It won't grow quite like this, but the yield's here. So in my brain, I sort of see JEPQ here and SCHD here, and that's the combo I'll use when I retire personally. And then as I get more and more clearance over inflation, I'll migrate more to the lower yield and the higher growth. But in the beginning, I will need to cover those bills. And before I jump down to these examples, dividends are not reinvested. So what that means is this is $1 million sitting in each of these 4 ETFs, and we're spending the dividends, we're not reinvesting them. So a lot of people think, well, you could invest the excess with the higher yield. That's true, but you actually give up even more future dividends when we eliminate total returns from the equation, because generally speaking, lower yielding ETFs over time will grow more. There's more price appreciation, and higher yielding ETFs, especially the high yielding ones, generally speaking, don't grow their price as much. We would have surplus to reinvest here over this one, but we would have even more total returns to reinvest in this one over this one. So in this, we're just going to let the compound do its thing and we're not reinvesting, but just know technically F would be a little better in most cases than C if we worked with the surplus of price and yield, AKA total returns. So you can see after year 10, ETF 2 finally passes ETF 1 in income. that 7% yield started producing more cash flow than the 9% yield. And it's because of the 5% growth compared to the 2. But it took 10 years. So that high yield's pretty powerful for a long time. And it took this 5% yield with the 8% growth 12 years to pass the highest yielding. And it took this SCHD-like one 14 years to officially produce more income than the high yield. So after year 14, this one's obsolete compared to the others. And then I like to see just sort of the individual matchups. It looks like you get more income with the 5% yield compared to the 7% yield after year 13, as you can see here. And for context, it takes 17 years for the 3% yield to pass the 7% yield on yearly income, as you can see here. And for the last one I'll show here, that 3% yield, the lowest, to the 5% yield, it took 20 years for the 3%er to produce more income than the 5%er. And the point I really want to show here, if you can afford to go with low yield, go with the high growth, you're going to steamroll inflation. It's pretty objectively superior. But if you're at a balance up here, especially if this is 500,000 or 450,000, you'll probably have to go with more high yield. And that at that point, you want to hybrid things together. So I'm just showing that yield and growth are both very, very powerful, but neither one's necessarily better than the other. It really depends on your specific situation. I mean, yeah, after 20 years, you might be, I don't know, dead years old, maybe. So find out what mix works best for you and massage the numbers to work in your favor. Now it's time to see how the big four of SCHD, VIG, DGRO, and VYM performed in the fourth quarter of 2024. I focused exclusively on dividend growth rate in my past recaps. Today I'm going to share a new metric, dividend power, that brings dividend yield into the mix. Fourth quarter key metrics. SCHD smashes the competition in dividend growth rate, and that's the case for any time frame at this point. But the total returns of SCHD were subpar in 2024 compared to the other big three. So what happens when we relax and zoom out? VIG and DGRO might have something to say about that. And before we dive in, just remember that all of these dividend ETFs are great for a reason. They have all been around for at least 10 years, and they produce an attractive mix of yield, dividend growth, and total returns. We'll be splitting hairs in this one, but just remember, you can't go wrong with any of these amazing ETFs. Let's see how things look after an exciting end to 2024. And we have to start out here with the dividend growth and the dividend yield. I'm all about those dividend stats. We'll get to total return though, don't worry. This is a cool spreadsheet that I keep, and it's free for anyone. It's in the link in the description below if you want to check it out. Basically what I do is every quarter I update the dividend stats for what I consider to be the best overall long-term dividend ETFs. And this is cool, it's dynamic. So last quarter, you know, the figures were looking different than they are this quarter. And this thing can look back quite a bit. You can change the year as well. The data's on some different tabs here, but we're going back to quarter 4 here. And as you can see, we'll just walk across. I added yield because we used to just look at the growth stuff, but yield is important. And you can see at 3.67%, SCHD dominates the yield of these ETFs. VYM is second at a solid 2.87%. And then DGRO is in the low 2s and VIG in the high 1s. They're made more for growth and they have a lot more technology. I had a comment specifically calling out SCHD for having a lower dividend in quarter 4 than it did in quarter 2. That's happened multiple times in the past, but the general sentiment was correct. It was a fairly low fourth quarter over fourth quarter growth for most ETFs. You can see here the fourth quarter dividend grew 6.9%, nice, for SCHD over last year's fourth quarter. But DGRO only increased by 2.1%. And then VIG fell by 4%. So its fourth quarter was 4% lower than its last year's fourth quarter. And then VYM fell 12%. So dividends in general didn't grow this year compared to last year, but the March reconstitution saved SCHD. We know it's been growing at a huge clip, spoiler alert, 12% over the year, but even the quarter got an increase in a rough all-around dividend quarter. And speaking of 1 year, we have a 12.2% full 24 versus full 23 1-year growth rate. DGRO had a 5.24 and VIG right there at 5 as well. And then VYM was basically flat in 2024. And now these are all just dividend CAGRs, and we'll keep working over here. In the last 3 years, SCHD wins again, 9.87, and it's pretty close to about 9 and 8 of DGRO and VIG respectively, and VYM at a very weak 4. It's interesting because VYM's always a bad grower, but its niche is that it has a high starting yield, but it's like, does it? And then in the 5-year CAGR, SCHD is at a monster 11.59%, and that's ironically very close to its CAGR since inception, by the way. DGRO has a 8.27% 5-year CAGR. VIG steps its game up a little at 9.6, and VYM bringing it up the caboose as always. Now we go out to the 10-year, in my opinion, the most important, because we want to see what our cash flow does over the longest period of time possible. SCHD at a very solid 11%. DGRO, and I use the 9-year CAGR for it, because it's just over 10 years old, but it doesn't have the full look back period. So the 10-year CAGR looks really high because you're comparing a full year to a partial year. So you have to go 9 to be accurate. It's right below 9%. And VIG is about a percentage point lower at 8%. And VYM steps it up a little bit at 6%. And so what I did here, I just took the average. Some people like the recency bias. Some people like these middle levels. And then people like me, like the longest look back possible. I just averaged them. So we get one solid number. You can't have a weak spot. This is average CAGR of these 4. And I kind of like that because who am I to say which one's the most important? And now this is my dividend power stat that I just added this time. And I really like it because I do think growth is more important. And well, the numbers are bigger. So if you look, this is just yield plus average CAGR. So SCHD is at 14.85%, a huge lead over number 2, DGRO at 10.1. And again, DGRO gets credit for that higher yield than VIG. Now, granted, it is slightly ahead on the CAGR, but I think you gotta say, yep, DGRO gets an additional nod for that yield advantage. And the dividend power for VIG is 9.5, pretty solid. And then a measly 6.63. That's pretty bad, honestly, for VYM. That's lower than a lot of ETFs, just straight up yield. SCHD just wins on dividend stats across the board. But remember, there's another important little stat called total return. Let's get to that. We're out on my favorite site for researching stocks and ETFs, Seeking Alpha. And if you are interested in Seeking Alpha Premium for a free trial, link in the description below. I love it. But we're here on the charting tab. And I'm starting with year to date. So what I've done is I've pulled up our 4 ETFs from this video. And a little bit of a spoiler alert, I have them in my favorite order. So SCHD is my favorite, DGRO is number 2, VIG's 3, and VYM's a pretty distant 4th, just because that's how I like to do things. So starting here at year to date, SCHD is in last place by a decent amount at under 13% total returns. This does include dividends. And then you have DGRO in second to last, but basically tied with your 2 leaders, VIG and VYM. So it's been a rough year-to-date total return for SCHD. And of course, year-to-date's going to be about what 1 year is at this point, but we'll look. 12.5 for SCHD, a similar 18 for DGRO, and VIG takes the lead. Uh-oh, do we have a new king at 19.11? VYM at a solid 18.82. And now we're out on the 3-year, and I noticed this yesterday when researching. SCHD's had a very rough 3 years, and we know it's been rough for total return for SCHD in general the last couple years, but it's just one of those things where the 3-year happens to grab a really unfavorable set of data. But it's at 14.4% to DGRO's 20.5%. And these are actually in reverse order. VIG is at 23.4 and VYM is the king at 26.6. All right, I hope everyone's confused. Or I hope everyone's thinking, well, Jeff put them in his favorite order and they're exactly backwards, so shows what Jeff knows. Zooming out to the 5-year, we breathe a little easier. SCHD is in a second place at 70% behind VIG at 76%, and then DGRO at 67%, and VYM coming in third, but competitive actually at 61%. It's interesting, so far DGRO has fallen short of VIG, and these ones always go back and forth with each other. And on the 10-year, oh, it remains. So this is where, when you zoom it out 10 years, this is where VYM starts to fall behind at 156%. You have SCHD still in second to last, but a respectable 188%. DGRO coming in number 2 at 195. And the king, VIG, just under 200%. So on straight up returns, VIG and DGRO said, hold my beer. Why is this guy always talking about SCHD? You can blind taste test me all you want. My mind hasn't changed. My winner remains SCHD. Adding the dividend power stat further solidified my preference for SCHD. I think it's reasonable to say that it has the best combination of dividend yield, dividend growth rate, and long-term total returns. It has the lowest PE ratio of these 4 ETFs, and it has virtually no overlap with any of my favorite growth ETFs. This is always important, but perhaps it matters even more in the highly priced market we're operating in. When growth goes south, and yes, believe it or not, it eventually will, SCHD will provide a solid floor for our portfolio. I think the balanced methodology will have it producing solid results for decades to come. Check out one of these 2 videos if you want to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching. I hope you had a Merry Christmas and a Happy New Year. And I will see you in the next one. Peace.